Hello and welcome to the deVere webinar series, the live webinar series, because I'm here live in Shanghai. Our guest speaker today, Sam, is live from Dubai. And today, a really interesting subject. We're talking about, is real estate a safe haven? With the financial markets being incredibly volatile, even more so again, bouncing up again today, falling yesterday. We're looking at, are there other investments we should be looking at, and is international property the place to be putting your money? Now, before I hand over to Sam, let me just quickly run through the format for today, what we're going to be doing. So first of all, we're going to do a poll. We want to know your opinion, what you think the markets are going to be doing, how they're going to be impacted by the coronavirus. Okay, well, I'll then be handing over to Sam. He'll be going through his presentation. And then following that, we'll have a Q&A, a question and answer. So if you've not joined us before, at the bottom of your screen, you will see a chat. Okay, so you click on the chat. What's important then is to put all panelists and attendees. And what that means is everybody can see your question. So put your question in there, ask away, whether it's during the presentation, something comes up that you want to ask Sam at the end, put it in there and I will ask those questions to Sam. I expect, because we've got quite a few attendees today, that we won't be able to get all of the questions answered, but get them in there. And if we can't get them answered during the webinar, then we can get them over to Sam and he can answer them afterwards. Okay, and then at the end, if there's information that you think, okay, this is really interesting, I want to talk to an advisor about this, I want to talk to an expert about this, we'll give you the opportunity to register your interest at the end as well. So Sam Barrett is our head of international properties. If you want to turn your mic, actually no, hold on Sam, actually one moment. Sam is the head of international property for the deVere Group, but we want to know what your expert opinions are, because everyone has an opinion about property. So let's bring up the poll now. And the question is, how do you think, or what impact do you think COVID-19 will have on property prices? So will we see a big rise, a small rise? Will property prices stay the same? Will we see a small fall, or will we see a big fall in property prices? Okay, give you a couple of moments to answer that question. And after Sam's presentation, we'll give you the results of that. So Sam, if you want to turn on your video and your mic. As I said, Sam has been working for the deVere Group for a number of years now, and is an expert in international property. He's the man who's doing the research on our behalf, bringing out the different developments and doing all that, or everything, the important stuff that our clients need to know. It all comes from this man here. And with that, Sam, I'll hand over to you.
Okay, thanks everyone for joining. Again, when I start these seminars, I really do feel responsible for it not being a waste of your time. There is going to be a lot of information given. I really do hope I give a well-rounded view about property as an asset class, why it's slightly different, and because it's slightly different, that does benefit you as an investor to have it as part of your portfolio. But before I really dive into the impact of coronavirus and how properties sort of I suppose reacted to it, just a little bit on who we are as a company. The business model, just to give you an idea of how we have our property department sort of structured. I head up the research team. So we have investors, 100,000 investors that obviously build their property portfolios through us. And the way that I sum up the research side of the business is more, it's taking the coincidence out of the equation. Okay, so I'm very much unbiased with different regions, with different developers. I'll make sure that wherever we have our clients investing, there is a real strong fundamental reason. There's a lot of research, not only in the market, but the developer themselves. The second part of the business model really is for you to get your head around, we don't develop. Okay, so it's not like we have our clients investing in deVere developments. What I'll do is I'll effectively work with different developers. So if you can imagine, let's just say that you've got a specific location, Birmingham, for example, in the UK. I'll look at the different parts of Birmingham, because not every area within that city is going to be the best place to invest. I'll pinpoint which area I believe and the investment team believe is the best place for investment. And what we'll essentially do is we'll have an exclusive contract with a developer that we believe has the development in the best location, and use those units to create sort of investment opportunities for our clients. Okay. The last part of the service, we've effectively got, I'll make sure that I'm We've effectively got an elite property service. If you can imagine that deVere's client base are multinational, international investors, we couldn't simply just offer an investment opportunity and say, good luck finding a solicitor, good luck finding a mortgage or a tenant. So we've created a platform. If you can think about what we do, deVere are a platform to help overseas investors build their property portfolios. So we have solicitors in both the UK and Germany that we effectively help clients pass on to. deVere Mortgages. So we have our own mortgage brokerage. We can facilitate the finance. And when it comes to lettings and management, again, if you're not based in the cities, and 9 times out of 10, our clients are not based in the areas they're investing in, we have our own letting agency in the UK. So we can effectively find a tenant and rent that property out for you. And in Germany, as you'll see, we've partnered up with one of the leading letting agencies in that market. The reason that we've created the elite property service is really to make sure that if you're looking at an investment case, whether that's in Berlin or the UK, you're really looking at that on the investment merits. Not saying, you know what, I can see why that's a good place to invest, but for whatever reason, I don't have the time to go and find my own mortgage and time to find a solicitor. So we're taking the hassle away so that you can focus on the investment case. Something that we've been we've been looking to introduce, but we haven't had the right avenue is at the moment, in the UK, it's becoming more and more tax efficient to own property through a limited company. Now, there are various benefits for you, but the only problem for us is it's been very expensive. If you have a UK limited company, to set up, it's cheap, but to run and have the accounts audited in the UK is usually quite expensive. But we've just been able to partner up with a company called GetGround. And again, a lot of the investors that are investing through companies are doing it specifically for tax benefits. The fact that obviously if you own property through a company, you're the managing director of that company, there's limited personal liability. So you've got it's not exactly like you've got a personal liability to that property, but it is essentially something that you own. For inheritance planning as well. Inheritance planning is something that a lot of investors, especially investors that are later on in life, are thinking about if they've got children. If you have your property held within a company structure, it's very, very, I suppose, inheritance tax efficient. And then obviously a lot of people say, well, if I've got a property owned by a company, can I get mortgage finance? Well, at the moment, mortgage finance for companies that are registered in the UK, audited in the UK, are as good, if not better, than if it's in your personal name. And then finally, just again, some of the tax benefits, you've got stamp duty, land tax, a lower capital gains tax, and then your mortgage interest can be deducted. Again, I'm going to summarize this very, very quickly, but these are just some of the strides that we're making as a company to help our clients build portfolios in property, but tax efficient portfolios. And then finally, what the company does, GetGround, obviously it's a £600 one-off fee. And for us, the key is this £280 per year in terms of the running cost. Now, this can be, if you're going through the normal avenues in the UK, up to £2,500 to £3,000. With GetGround, it's £280 a year, around £20 to £25 a month. And the company does everything from the accounting, the tax filing, legal documents, and secretarial work. So it really is something that we're very, very happy to have partnered with. Okay, so now more on the market update. And obviously you would have seen some of the fallout, I suppose, globally off of the coronavirus, but I'm going to talk specifically about oil prices. So again, for those of you who don't know, the Saudis, obviously I'm based in Dubai, so this is quite close to home for me. Aramco and the Russian, I suppose, oil producers had a deal on the table that was going to help increase oil prices by limiting the supply. Now, the Russians didn't like some of the concessions that they had to make. So effectively, they backed out of the deal, which led to the Saudi government, or the Aramco, saying that not only are we going to not restrict supply, we're actually going to increase supply. So you increase the supply of oil, and obviously we saw the huge drop. And I would say that was the real tip of the iceberg. That really is when you saw not just oil drop 30%, but the S&P start dropping, okay, down 5% in a day. And then the FTSE dropped 7%. That to me says, okay, well, one, you've got these assets that are highly liquid, but they're also very, very volatile. So again, I'm not saying that you shouldn't invest in them, but this is something you have to understand, that if you've got a portfolio that's heavily weighted towards asset classes that are highly volatile, it's not uncommon to see a drop of 30%, maybe not in a week like we saw, but a drop in 30% in a month in the oil market perhaps wouldn't be as uncommon. And then you think about coronavirus. I would say that coronavirus was more of an impact initially on demand. Okay, China is obviously, as most of you will know, the biggest consumer of copper. I used to trade copper, spent 8 years in the city of London trading non-ferrous metals, so copper, aluminium, zinc, lead, tin, nickel. If you look at how copper reacted to the coronavirus, so this is the chart from the London Metal Exchange, which my brother, who actually still works down there, sent over to me, of lead, zinc, and copper, of which China are all the main consumers of. Okay, so the coronavirus, you've got China basically saying our demand isn't as high because we've got enough problems trying to combat this virus. And again, this is over the 3-month period. So you can actually see, this is since September. You've got fairly consistent demand. And then as of January, you started seeing the coronavirus impact increase and the demand for copper decrease. And then finally, off the back of the oil drop, you saw the major drop. But that basically shows that one, supply and demand dictates where asset prices move, and property is no different. Okay, so supply and demand does dictate where property increases. What I would say is different with your asset classes like commodities, like energy, is that they are more liquid and they tend to be more volatile, which is, I think, is a key point, which leads me on to the next sort of part of the presentation, which alternative assets. So this is a newer type of asset that would not be considered part of a traditional portfolio, okay? So if you think that your traditional portfolio tend to be made of equities, bonds, make sure that, and cash. So that would be your traditional portfolio. So an alternative asset would be anything from private equity to cryptocurrency, and then residential property. Now, the key with alternative assets and why they've been so popular over the last 10, 20 years is the fact that an alternative asset will react differently to a sudden change in market condition to a traditional asset. So any financial advisor, and I'm sure the guys over in China profess to their clients to say that you want a balanced portfolio. Well, if you've got bonds that react very, very similarly to equities in your portfolio, and your portfolio is majorly weighted towards those asset classes, then how diverse is it? Where you would see residential property come into the fold is that would be an asset class that would tend to react differently to equities, bonds, and cash sort of sits there losing money anyway. We all know that. The only difference I would say with residential property in terms of an alternative is that the risk profile of residential property tends to be a lot less than these other alternative assets like private equity, like cryptocurrency. And then going back to supply and demand. So if you look again at the UK market, and bearing in mind that we are looking at supply curves, when I look at different markets to have our clients invest in, the UK market is quite commonly known as very heavily undersupplied. Okay, so you've got the UK government in October 2005 brought out what's something called a Barker report. So this was a report that started 2005, was going to end in 2015. That they basically said that we need to build 240,000 homes every single year until 2015 to facilitate demand. Now this graph shows that we've consistently built under 200,000, okay? And that wasn't because we didn't want to build more homes, but because you look at markets like the UK, there's a finite amount of land. The land that is available is usually protected now. So the only place that developers can build, especially in London, are up. And that's essentially why you've got this consistent increasing of house prices. We're now working at around about a 50% shortfall because the report ended in 2015, and that the amount that we need to build was revised up to 300,000. So if you look at the supply curve of the market that I'm currently standing in, Dubai, it's a different story. So you think about, you've got 31,000 homes in 2019 that were completed in Dubai. Now the average demand for the last 5 years has been for 15,000. So the local market, they're actually building twice as many homes as they need. So effectively, you've got a place where you've got an undersupply and an area where you've got an oversupply. Now I can say, and I actually rent my property in Dubai. We're actually standing in my property. I've been able, off the back of the oversupply, to negotiate down on my rent for the last 5 years, believe it or not. That's something that you wouldn't see. It's quite typical in the UK for investors or for renters to understand that they will need to be paying more year on year if they've got a property in a specific location. In a city centre in the UK, renters are quite unfazed when you have rental increases. Okay, so thinking about the security of property as an asset class, especially in the UK, this for me says two things. So this is the nationwide real house pricing index. Okay, so you can actually see that, okay, it's not linear. In 1989, we had a property crash in the UK, and then prices recovered. In 2008, we had the major crash. So this was the global financial crisis. That to me says that supply and demand dictates where prices move over the medium to long term. Remember, if you have a crash, but after that crash, supply and demand doesn't change, you will get a rebound in asset prices. Okay, but it also says to me that really to get the most out of property, it benefits to be a medium to long-term investor. My view, if you're looking at property as an investment, it should be boring, it should be predictable, but you should be confident in an area where you're going to get a consistent rental demand and capital growth. Okay, so then again, talking more on how safe is property and what is the impact coronavirus is going to have on the property market. Well, I'm going to say that the coronavirus, providing that it doesn't last for 2-3 years, is going to have a very limited impact on the UK property market in specific areas. And the reason I'm saying that, it isn't just a guess. It's basically saying that we can draw parallels between the coronavirus and Brexit. Okay, so if we're looking back at the last 4 years, you'd have to say that Brexit was unexpected. I think even though most of the country voted no, which is why Brexit happened, the general consensus from the global economy was that we would remain in the EU. The second thing that we can say is a comparison is the uncertainty. Uncertainty has obviously been caused by coronavirus, but the Brexit uncertainty from investors, you have to say that's been apparent over the last 4 years. And then lastly, Brexit, obviously very, very much uncommon. And the coronavirus, we'd like to think, is going to be a one-off. Hopefully the next time this happens, we'll be a lot better prepared. So to look at the impact the coronavirus is going to have, we have to take a look and say, well, what impact has Brexit had on the UK economy? And this is the UK Land Registry. One of the big reasons why we like the UK market is that there is so much data on the UK market. So this shows the UK average house, the average house price in London as of January 2015 to October 2019. You had an average house price of 402,000. Okay, this is the month of the referendum. So as of June 2016, the average house price in London pretty much leveled off. We went from 402,000 to 475, and then in October 2019, we're at 477,000. As it stands, we're around about 480,000. So the increase between June 2016 till now has been about 1%. So if you're saying, well, what impact has Brexit had? You'd have to say it's been heavily on London. One thing I would say about the UK market is do not see the UK market as just one housing market, because a lot of investors, especially from the Far East, especially from the Middle East, view the UK market as dictated by London. I would say see the UK market as more of a collection of completely different markets with completely different dynamics that see house price growth at completely different rates. What I mean by that is if we take another city during the same period, okay, Manchester, and we look at the house price growth, okay, this is from January 2015 till October 2019. There really wasn't even a blip during June 2016, during the month of the referendum. In fact, Manchester saw a better house price growth over the last 4 years than it had done over the last 15 to 20 years, 7.5% per annum. Why is that? Well, the government, in a short summary, has made it a key investment driver for them since 2010 to decrease the divide between the north and south. Okay, so a big impact on Manchester has been the digital and tech community. This area here is somewhere called Media City. The BBC, ITV have now moved into Manchester, they've relocated from London, which has effectively created more jobs. It means that there's more graduate retention and the wages have increased in Manchester along with the property prices. Again, another market outside of London that we're very bullish on is Birmingham. During the same period, January 2015, a property price on average of 144,000. This was the month of the referendum. Again, not even a blip. 189,000, October 2019. Okay, if you think about Manchester being a digital and tech hub, I would say think of Birmingham as sort of a financial hub. Okay, so HSBC have relocated out of London. They're headquartered now in Birmingham. Deutsche Bank have done the same, headquartered in Birmingham. RBS, KPMG, all major multinationals that have set up a real base in a city that is outside of London. Now, that wouldn't have happened 10, 15 years ago. What I'd like to just go back on here, and this really is talking more specifically on this presentation, this seminar, and is property a safe haven or not? Now, if you'd have seen the FTSE during this period, or more volatile asset prices during this period, during Brexit in the UK, then you would have undoubtedly seen a drop in, well, let's just say equities. We can see firsthand the impact that Brexit had on the currency. The reason that we did not see a blip in either Birmingham or Manchester is because of liquidity. Okay, you effectively, as an investor, cannot panic sell property. That's the key. That's something that I want people to take away from in terms of how secure is my asset class. The fact that you've got, you know, this pause, and we had this pause in property, it didn't give time for investors to really sell their property. And by the time that people were thinking about selling, we realized that the impact on the UK market wasn't actually that great. Okay. And then it sort of goes to what happens to my investment in the worst case scenario. Okay. So this is something that I've put into this presentation. It's something that you wouldn't potentially hear from a head of UK property investment. But I want investors to see the impact when times are the hardest on UK property. So this is a graph from the JP Morgan Asset Management Report. And I'm going to focus on this graph. So this is the total return on UK residential property since 1981. So basically in property, you've obviously got two ways of earning your wealth. You've got capital appreciation and you've also got your rental income. So this is your yield. So your total return is the combination of your capital appreciation plus your rental yield. So you can see in 1989, we had the property crash. So you had 3 years of capital appreciation decreasing. And then in 2008, 2007, we had the global financial crisis. Okay, so again, you had 3 years of negative growth in residential property. Have a look here at where rental yields went in times of a crash. They actually increase year on year. This is where I think property does differentiate itself to other asset classes. Remember, if asset values fall in property, it means that people can't buy. So if people in the UK can't buy, they're not going to effectively live in a tent. They have to live somewhere. So rental yields year on year would logically increase. So if you have a situation where you have an investment property in the UK and capital values did fall, let's just say next year or the year after, but you've got a rental yield that is effectively covering your mortgage, then you can leave that asset. And we know that the asset will rebound because supply and demand dynamics do not change. Again, for me, this should be a medium to long-term hold. So effectively, if supply and demand doesn't change, we really are not going to see much of a change in the medium to long-term trend of property prices in the UK. So again, just more of the recent market update, the government measures. The UK government has recently announced a 330 billion sort of a loan fund for businesses to fight coronavirus. I think when it comes to coronavirus, the government is more sort of concerned about the sort of the global impact that it will have. I wouldn't say more concerned, but is preparing itself for the global impact as much as it's preparing itself for the human impact. And for me, that is a very quick decision by the UK government to say that we are here to support. We are understanding this is a very short-term blip, but we're here to help businesses, which I think is a major advantage of the more emerged markets like the UK and again, like Germany, like the US, to show that they are supporting local businesses. We can also see the interest rate cut. So again, if you're thinking about property investment, I would say this is the interest rates in the UK as of 1979. We can actually see it's probably the most competitive time to be investing from a credit level in the UK market. So this goes up to June 2017. This is as of March 2019. Okay, sorry, March the 19th, 2020. So UK interest rates have actually been dropped to their lowest point ever. Okay, so again, when you're thinking about what pushes a property market to increase in value, the accessibility of credit is absolutely key. How accessible is it for someone in the UK to effectively get a mortgage? Because that's where really property prices increase the most. The availability of people in the UK to actually get mortgage finance on residential property. Interest rates are lowest in history. So if you think the lending rates for an overseas investor at 3.5% to 4%, whether personal or if you're buying through a company, again, that gives you this scenario. Let's just say that you take a mortgage out on an investment property. You've got a lending rate of 3.5% to 4%. Your rental yield is around 5% to 6% because we're not investing in London. We're looking at areas like Manchester or Birmingham, where your rental yields should be around 5% to 6%. Your rent from day one is going to be covering your mortgage payments. That means that if worst case capital values fall, you've got an asset that is covering itself. That is an absolute key point in terms of the security of your asset, the security of UK property. Remember, the period where investors came unstuck is when they were chasing capital growth in London and their mortgage payments exceeded their rental payments. That isn't a situation that we have at the moment in the UK. And then you've got the FX overview. So if you look at since February 2020, the pound, obviously we are a company that deals predominantly with overseas investors. The impact on sterling against the other major global currencies, well, just taking a look, if you look at the impact on Chinese yen, the 10-year impact, you'll be saving about $500,000. The impact since February 2020, the saving on buying a £250,000 UK property would be 205,000 yen. In US dollar, against the 10-year average, right now, as of March 2020, the saving is about 100,000 US dollars. And the saving as of February 2020 off the back of the coronavirus is around 34,000 US dollars. Again, we can carry on. In Hong Kong dollar, the 10-year average, 250,000 pounds, is 752,000 Hong Kong dollars. The saving as of February, so within 1 month, if you're investing now, as opposed to in February, the saving is 271,000. And then you've got Japanese yen. Okay, so the 10-year average, 250,000 pound property would be costing you 2 million yen less. And then the saving as of February 2020, I can't see that being right. I think that might be the other way around. You're looking at 3 million. But again, the saving across the board is a huge one. So we've covered the government's reaction. We've covered interest rates. We've covered the impact it's had on sterling and the opportunity we have on this currency window. And effectively, just to give you an idea of some of the infrastructure projects that are happening in the UK. Now, these aren't being halted. These are still going ahead. And one of the big projects that has just recently been given the go-ahead is a high-speed train line. This, for me, is one of the big reasons that we've seen the jump in property prices in Birmingham and why we're still so bullish on the market. So this is a high-speed train line that will be connecting London to Birmingham in 49 minutes. Okay, that for me, if you think about the difference or the impact this will have on Birmingham to London, that makes it commutable. You've effectively got a chance where someone from London can live in Birmingham and effectively commute to London. You understand the population in London is 9.4 million. The population in Birmingham is 1.3 million. That's suddenly going to have a huge impact in 2028 to the population. And then you start benchmarking property prices, because if we've got an increase in population, we've already got HSBC, Deutsche Bank, RBS moving into the city. What's the difference in property price? So again, for me on an investment standpoint, I'm looking at prime central London at £2,500 per square foot, whereas central Birmingham, and again, this is where we have our investment property portfolio of £400 per square foot. That for me is, I'm not saying that we're going to have £2,500 per square foot, but I wouldn't say it should be too far away from £800 per square foot in prime central Birmingham when we creep up to that 2028 period where HS2 is going to be operational. So just talking very briefly, now I want this presentation to be more educational, but just to give you an idea of where our head's at in terms of the investment team, this is a location that we have our latest project that we launched a couple of weeks ago. Again, we are more centered towards the Curzon Street station. So this is going to be the HS2 interchange. And this is a £1 billion regeneration scheme. Okay, so the project itself sits in between one of the largest regeneration schemes in the UK at the moment, but also within driving distance of Curzon Street. Now, this for me is where the key investment driver is. The development itself, again, is in Digbeth. The specification is targeted towards young professionals. It's targeted towards people that are potentially relocating from London that are expecting a higher level of quality. And again, just to give you an idea on the pricing, we're not looking at £500,000–700,000 apartments, but prices starting from 219,000. The completion date is Q3 2021. So Q3 next year, if you're slightly worried about the rentability of an apartment in the UK in the next few months, this is the reason that we like a longer build time. You can invest 20% now, so around £44,000, and effectively wait for the project to complete for Q3 2021 for you to actually be able to rent the property out, which we would like to think everything in terms of the coronavirus has cleared up by then. Okay, so now talking more about Berlin and how Berlin, in terms of the investment case in property in general, but also how does Berlin react in times of uncertainty? One of the big questions that I get asked as part of the investment team when it comes to Germany is, you know, tell me what are the fundamentals behind the city or behind the economy itself? Because people have heard about Shanghai. People understand the market in the UK is always very robust. People understand New York, Sydney is an area that is very, very common for property investors, but Germany doesn't tend to be top 5 or even top 10. Well, if you think about Berlin, and this is one of the reasons that I love this particular market, it's the capital city of the 4th largest economy in the world. Okay, so if you think about the global economies, the UK economy is actually 6th. Okay, so Germany's 4th. You've got the 4th. You've got the capital city of Germany, and then you think about Berlin. Why is it an area that we focused on? Well, Berlin isn't actually amongst the top 10 in terms of price growth in Germany alone. Okay, so you've got areas like Munich, Frankfurt, Hamburg, all that are valued at around 400,000 to 450,000 on average, whereas Berlin's average house price is 263,000. Okay, PwC have voted it #1 for real estate investment for the last 4 years. But then you start to think, and this is where I started to get to grips with the investment case. Why is Berlin different to the likes of Munich and London, if it is the capital city of the 4th largest economy in the world? Well, the reason that we've pinpointed the city is because Berlin's price growth has only really started to occur over the last 15 years. Remember, after the war, Berlin as an economy was hit the hardest. Munich decided to be sort of centers of engineering. You had Frankfurt that decided to be centers of finance. Whereas if you went to Berlin in 2004, you had 19% unemployment. All of a sudden, in the mid-2000s, there was this explosion of, digital and tech, or the digital and tech sector really did start to take hold of that economy. And now 1 in 7 jobs are in the digital and tech sector. So over the last 15 years, you've got all of a sudden this huge explosion of digital and tech. And now you look at the unemployment rate from 19%. Unfortunately, this graph doesn't go until 2019, but you've now got an unemployment rate of 7.2%, 7.6% in 2018. So it was actually the biggest decrease in unemployment over a 15-year period of any emerged market. So then you start to understand why we're very bullish on the property market. And to be quite honest, the property market in Berlin was not prepared for this sudden explosion in digital and tech. 40,000 people now moving into the city every year. You've now got a vacancy rate of 1.1%. Okay. So when you look at the impact that, let's just say, a coronavirus or a major economic event will have on a city like Berlin, well, one, it's the political heart of Germany. But two, with a vacancy rate of 1.1%, effectively, you've got these people that are moving in. It can't get really any lower. You're never going to have a zero vacancy rate. Effectively, if you flip that on its head, it means that 99 or almost 99% of the property in Berlin is already acquired. And then you look at over the last sort of 4 to 5 years to show you how robust the city is and how prepared it is for a particular global correction. This is the GDP growth compared to the German average over the past 10 years. You have the dark green as Berlin and then the light sort of gray as Germany. You can see Berlin's economy is consistently outpacing the likes of the rest of the country. So this encompasses Munich, Hamburg, Frankfurt. And that's because Berlin's economy is a lot more diverse than your quintessential economy in Germany. You've not just got a digital and tech hub, but you've also got a strong banking sector, consultancy, law. If you think about it's the political heart of the Germany, it's a huge research and development hub. Now, when you've got an economy, the same as the UK, a very diverse economy, even though you'd have to say the UK is still very much centered around the financial service industry, a more diverse economy does prepare itself a lot better to global corrections, which is why we're still very bullish on this particular market. And then you look at some of the regeneration. So you look at what's being pumped into Berlin's economy. Over the next sort of 5 years, you're going to have effectively its first central business district. So a central business district is something like the financial sector of London. You'd think that somewhere like the capital city of the 4th largest economy in the world would already have a central business district. But because we've only started to see this economic growth in Berlin, we actually don't have one yet. Now, this is going to change as of 2028. Again, you're now going to have a central business district called Europa City. So this is a €5 billion regeneration plan that will effectively, well, it's already started, but these major multinationals will start to enter the city. And that's off the back of an infrastructure project that can't be understated. So at the moment, so much that Berlin doesn't have a central business district, it also doesn't have an international airport. As of November 2020, and we say November because it's just had its first scheduled flights out of Berlin-Brandenburg, Berlin will have its first fully international airport. So at the moment, if you can imagine, Angela Merkel, who lives in Berlin, it's the political heart of Germany, cannot fly out of continental Europe from Berlin. As of November, that will change. Now, it can't be understated the impact that will have on the major multinational corporations entering in the city. Now, if you have got pens and papers, I would just say jot down Google, Tesla. So Google have just set up a headquarters in Berlin, and Elon Musk has basically just scheduled that the next big Tesla economic hub outside of the US, so you've got China, and it will now be Berlin, and the location will actually be in Brandenburg. So if you think about all these things put together, you start to get an understanding of how unique a situation this investment case really is. And again, the mortgage side is really where I think that the global economy for the brave investor, okay, really is seen as an opportunity. So across all the projects that we have in Berlin, you will be able to achieve 70% loan to value. And because the ECB's interest rates are now below zero, for an overseas investor, you're able to lock in a 5-year fixed interest rate of 2.9%, a 10-year fixed interest rate of between 1.3% to 2.9%. The 1.3% is only on properties that are over 300,000. And as an investor, you have to be able to prove that you have a salary of over 70,000 US dollars. You can fix your interest rate of 3.6%, and you can fix your interest rate of 3.7% for 20 years. So again, extremely competitive interest rate markets. I can't understate for emerged markets how accessible this is. So again, just to summarize the key investment fundamentals behind Berlin. Again, finance you're able to achieve on a client-by-client basis, but the absolute worst case, even for those investors based in Shanghai, would be 2.9%. For those investors that qualify, they will be able to achieve 1.3%. In Germany, there is zero tax to pay if you hold a property for over 10 years. So if you're an investor that is quite confident having a medium to long-term hold, and you have a property in Germany that is worth 500,000 that you bought for 200,000, if you were to sell that after 10 years and 1 day, that 300,000 euro profit would be hitting your bank account. There's zero capital gains tax. You've also got this sudden increase. Remember, we're so far ahead of the curve when it comes to Berlin. Munich, Frankfurt, Hamburg, they've had property prices that have increased over the last 20 to 30 years, whereas we're only seeing the increase in property in Berlin over the last 5. And then finally, you add in the international airport, okay? A fully international airport, as of November this year, the impact that that's gonna have on the economy in Berlin, and that's without talking about Europa City, so Berlin's first central business district. And again, a very quick overview of some of the developments. So we've got 2 developments at the moment. This is only one development I'm going to be talking about. We like to keep investment prices accessible for investors. So starting price, so this is a boutique 76 unit scheme, starting price of 200,000 euros. The project completes in Q4 2021. Bear in mind, you would exchange contracts as of a month after reservation. And by the time the project completes in 2021, you would effectively be 2 years into that 10-year period. The project itself is a stone's throw away from Berlin's central business district. It's 180 meters away from the closest underground station. You're an 8-minute and 10-minute walk away from 2 major universities. So we've been very, very, I suppose, I'd say picky over where we had our first project in Berlin, but we've chosen this specifically because we understand Berlin's market is a market that is about to see a boom in activity, but we wanted to have, and it's my job as head of the investment team, to have a project that is pinpointed in the best area within that market. And again, you've got the payment plan. You're looking at, on exchange, the acquisition costs. So around 20,000 euros, but from an investment standpoint, if you're looking at a 70% loan to value mortgage, with your acquisition cost, the total amount required to invest in a project in Berlin would be 80,000 euros. Okay, so the final slide from me, I would say...
Hi Sam, sorry, can I quickly jump in, mate? I know we've had a lot of questions come in, so I was just going to say, if people wanted information specifically on this, then we can actually get it to them after the webinar. I wanted to pick your brain before we run out of time.
It's my last slide. I'll give a quick summary, and I'll start to give a bit of an idea on the questions. Yeah.
Perfect.
Okay. So I think one thing to summarize from my side is that with property, I really do see the benefit of it being a medium to long-term hold. And realistically, once short-term panic subsides, long-term trends do continue. I think we also must understand that when it comes to property, and we can see this off the back of Brexit, you cannot panic sell. So a lot of investors are wary about holding property in their portfolio because of the fact that it's less liquid than other asset classes. But that's why you can see a 30% drop in oil. You can see the S&P trading at 20% lower than it was a couple of months ago. Okay, the fact that the property is illiquid in its nature really, for me, gives it a security, gives it a blanket to know that once these sort of real short-term economic events occur, providing that they don't last, a year, 2, 3 years, we will be able to see a fairly consistent rise in property. And the last thing, when you've got things like historically low interest rates and a currency window that is, you'd have to say, unprecedented, especially in the UK, it really is for the brave investor to understand that, okay, whilst other investors will actually halt and feel like cash is king at a time like this, this would be a period where I would say it's the brave investor that sees this as more of an opportunity. And I think that's what we're seeing, certainly from the investors that are speaking to me on a daily basis. All right, so some of the questions. So is this the chat that I have to click on, Will?
No, no problem. I will ask you the question, Sam. You just sit there and listen, and I'll go away. Thank you so much for that. And I hate to cut you off, and obviously it's really good information. We've had so many questions come in. So I will start off. Actually, an interesting one. So, what's your view on the difference between REITs, so a real estate investment trust, and actually holding physical property?
Right. Okay. So what I would say with a REIT, and bear in mind, we actually had the opportunity to take on a REIT and offer it to investors. Hopefully you've understood by now over the last, however long that's been, 45 minutes. Now, the one thing I love about property is that supply and demand dictates where property prices move. Okay. As soon as you invest in a REIT, two things happen. A REIT, the underlying asset will be property, but it will tend to be commercial property. Now, commercial property doesn't react the same as residential property. Commercial property will tend to correlate with equities. Remember, it's firms that own commercial property. So the underlying asset, even though it's property, tends to be an asset that doesn't really follow supply and demand characteristics. And as an alternative asset, you know, it then falls more into the equity side of it. So as an alternative, I feel like that takes away from it slightly. What I would also say is that a REIT is commonly traded on the open stock market. Okay, so all of a sudden, again, the benefit with property and it being a more longer term hold, the fact that it's illiquid shields it against sudden drops. If you've got a REIT, so the biggest REIT in 2006 was the Dow Jones ETF iShares Real Estate Investment Trust. Now that when times were booming, was giving a dividend of, I think, of around 8, 9, 10% per annum. But in 2007, when, you know, we had the global financial crisis, investors sold their REITs. So you saw I think it was a 20% drop, and then it was a 40% drop in a year. So as soon as you have something that's not, you know, there's something that's traded on the open stock market, it then you know, you've got something that isn't as secure as an investment property would be.
Yeah, you're losing out on a lot of the benefits that you have from holding a physical property.
From holding residential property, the way you're going to get a consistent rental demand and real persistent capital growth. Yeah, it's effectively a stock.
Yeah, it makes a lot of sense. From Miguel, so if I want to buy property in Southeast Asia, can deVere help me with that? I.e. Bangkok, Ho Chi Minh City, Hanoi, Jakarta, or any views on those markets?
I would say from my side, so the reason that we've entered in Germany, you know, it gives you an idea that we're not just focused on the UK. Obviously, the UK is where we've centered our investment property around the last 4 years. I'm constantly looking at new opportunities. I'm constantly looking at new areas that we can build our clients. Because I want deVere consultants to be able to speak to clients and say, we can build you a fully international portfolio. The only problem I have, especially in areas like, you know, Southeast Asia, Bangkok, you think about those areas are very much centered around, I suppose, local investors. And the governments are very much centered around helping local investors or local residents in those areas buy property. It's not as receptive for foreign investors. If you think we've got 100,000 clients, I need to make sure that someone from our Spain office in Malaga or Barcelona, someone in our London office or someone in our office in Zimbabwe, they've got the same opportunities to be able to invest as investors from Southeast Asia. And at the moment, there's certain things with the government and it's sort of emerging markets that I'm not 100% confident on to give me the, I suppose, confidence to have investment property in those areas. Remember, I really am not promoting this division as a deVere real estate brokerage. This is a sort of an investment arm that uses property. And when you get those sort of markets, I have to be completely 100% confident in the fundamentals. And until now, I'm not quite there yet with Southeast Asia.
Yeah, no, that's fair enough. And that's exactly the way that our financial advice follows as well. It's the safe and secure investments that we want to be making. Absolutely.
Yeah, and emerged markets always offer that. And remember, the historical performance of the likes of the UK, of Germany, gives me so much confidence that in times when times are really hard, you know, you've got that historical analysis to say that this is how the market reacts. We don't tend to have that in the more emerging markets.
Yeah, absolutely. So one on mortgages, the lending rates you were talking about, is this mainly buy-to-let mortgages? Specifically in the UK, Albert said he understands that this is higher than residential mortgage interest rate.
Yeah, so what I would say that the residential mortgage in the UK, if you're in the UK right now and you're looking to buy, then the interest rate should be about 1.5% to 2% maximum. So the lending rates that I'm saying now, between 3.5% and 4%, that's actually for both a personal buy-to-let investment or also if you hold the property within a company. We've had some problems as well with overseas investors, especially from the Far East, opening bank accounts in the UK. If you go via a company structure, the company GetGround that we have obviously partnered with, they will open up a bank account for you to be able to facilitate finance. And then we've got 25 lenders that will be able to offer lending specifically for company structures. Okay, so in the UK, I would say 3.5% to 4%, whether personal or company structure. I would definitely suggest investors in the Far East go for the company structure now that we've got the fees so low. And then in Berlin, it's again, the market, the ECB have lowered their interest rates, the sort of interbank rate to below zero. So absolute worst case scenario for an overseas, say someone that's based in Shanghai, that's Shanghainese, wanting to invest in Berlin, the worst you would get, providing you can provide an income, okay, and you can provide proof of address and proof of identification, would be 2.9%, and you can fix that for 10 years. In Germany, what the banks do is they lend on the specific project. Okay, so we've had a huge jump in investor interest from the likes of Africa, India, and the Far East, regions that typically find it harder to invest in the UK because the market in Berlin is so receptive to finance. It is a situation of worst case scenario. You're looking at 2.9%. If you have a property of over 300,000 and you earn a salary of over $70,000 a year, we should be able to get you lending at 1.3% fixed.
Okay, excellent. All right, thank you so much for that, Sam. What we're going to do is I'm going to send you over a bunch more questions, and so we had a lot of them come in, and then we'll distribute the answers into the WeChat group. So if you're not in that WeChat group, talk to whoever invited you to the webinar and they'll get you in. We've also got a few other property experts in there that can help you out. So obviously it's been a lot of excellent information from Sam today. And a lot of you will be sat there thinking, okay, I want to act upon that information. I want to know what my options are. Okay, so what we're going to do now is give the opportunity to reach out to an advisor. There's going to be a poll that comes up. And if you want to talk to someone, whether it's about different investment opportunities, whether it's about getting a mortgage, or whether it's just other investments that you want to talk to an expert about, the poll is going to come up now. And click on one of those options, and we'll make sure that an advisor will reach out to you to talk to you about your individual specific situation. Okay, and with that, Sam, I'd like to say thank you very much for your time.
No problem.
And thank you everyone as well for attending, for your questions, but also for your donations to coronavirus frontline health workers across Asia. We started off in Wuhan. Unfortunately, we're now helping out across Asia, but it's an excellent cause. And of course, the money will be going there. You can look up on the link. So enjoy the rest of your evening. Thank you. Good night.
Take care.